It's a strange time in America. From an economic and cultural perspective, we are at a major crossroads. The economy is a mixed bag to many people. On one hand, the stock market is booming and unemployment is low. On the other, everyday costs like food, housing, cars, and insurance are skyrocketing. America is split between the supposed newfound paper wealth and the end of anything affordable. With a new administration promising change, people are wondering where the economy is headed. Is a crash coming like many predict, or are good times ahead of us? Well, the first thing we need to look at is the pulse of the people. A simple question needs to be answered, yet across the internet you will find no apparent, clear, consistent response. It's really simple. Is the economy currently good? And in my opinion, it's clearly not. Those who don't believe this will quote a lot of good things. They will say unemployment has largely been below average since 2014. The S&P 500 has gone up 82% since 2020, and they will even say a typical McDonald's employee went from making $12 to $15 an hour in that same time. A 20% increase. All of those things are true, and for a lot of reasons on paper, things are going well, but there's a hidden truth that everyone is feeling, and it's becoming very clear that the answer to the original question is a resounding no. Everything is not okay in the economy. In the 2024 election, exit polls showed clear frustration over this exact issue. According to the New York Post, the economy was the top point for voters, with only 13% feeling financially better off than before. In fact, 63% rated the economy as not so good or poor. Inflation, often called the hidden issue of our time, was the major concern, with MarketWatch data showing that 75% of voters saw it as a significant hardship. This reality is what led to this massive move at the polls for this guy and his party. It was a vote intended in large part to change the economic direction of this country, and there is valid proof that the markets are actively reacting to this reality. Right now, there is something called the Trump trade that is unfolding in the bond markets. And what it's telling us is shocking. To understand it, we first need to take a step back in history. You see, like I mentioned before, inflation is a major issue for people. It acts as a hidden tax on the populace, but it's also an issue for a different reason for politicians. To spare you the burden of explaining bonds, interest rates, and macroeconomics, just understand this. This here is the federal funds rate set partially by this guy who's appointed by the president. This figure influences interest rates across the board. When this rate is lowered, borrowing becomes cheaper, which means credit cards, mortgages, and car loans all typically get less expensive. This is great for business because it brings more money into the economy, like lowering gravity makes it easier to jump. Naturally, presidents and politicians want this rate low to boost economic activity, but there's a downside. This easy money effect can act like a sugar rush for the economy, leading to higher prices, which is what we call inflation. But politicians don't care. Inflation is a downstream effect. It creeps up slowly rather than causing an immediate shock, meaning that people don't really notice it until it's too late. In fact, in a lot of ways, inflation will have you mistaken that you're actually getting rich. People who bought homes in 2020, for example, saw their home values explode 49% in just 2 years. Stocks have followed a similar pattern, creating the illusion of getting rich, with S&P 500 portfolios gaining 80% in the same period. No politician wants to advocate for higher interest rates because they bring economic pain, which is necessary to tackle inflation. Without that pain, there's no real fix. The way our political system is set up almost guarantees that no candidate will prioritize the long-term impact of their interest rate strategy. So where am I going with all this? One word: stagflation. And the scary truth, no one really has a plan to deal with it. Remember what I mentioned earlier about the Trump trade? Let's break it down simply. Imagine the economy as a car. Our goal as a nation is to get this car moving as fast as possible without crashing. The crash here is inflation spiraling out of control. Now, the Fed, led by Jerome Powell, sets the speed limit. The Fed's fund rate is the limit on how fast we can drive. The bond market, represented by the 10-year yield, reflects the road conditions ahead. Right now, Powell is raising the speed limit, which sounds great in theory because it gives us room to go faster. But here's the problem: the road conditions are getting worse. The 10-year yield is rising because bond traders believe inflation will keep getting worse, like rain and fog thickening on the road. As we're told to go faster, we're actually headed into rougher conditions. Meanwhile, the team captain up in the White House doesn't seem to care about these risks. He's saying speed up, don't worry about it. And that's what the Trump trade is all about, betting that the danger, in this case inflation, will increase and that bond traders will keep pushing up the 10-year yield as they anticipate higher long-term rates even as short-term rates fall and taxes drop. Essentially, it's a bet on unchecked inflation, the same problem that's causing people to feel all this economic pain. We've all probably heard of Peter Schiff, and in his most recent podcast episode, he spoke about this directly, stating the sad economic reality that will occur if we stop caring about taming this problem. Take a listen to his explanation, and remember, he's a fan of the future president and an open Republican.
Well, the Trump trade continues to motor forward, led by the bond market. I think that's really the most significant market, and it's infecting other markets in a significant way. But the yield on the 10-year U.S. Treasury closed at 4.44. That's the highest it's been since Trump was elected. 30-year yields, people don't talk about those as much, but we're at 4.62. So we're now closer to 5% than 4%. You know, we were below 4 when the Fed cut rates by 50 basis points. What was that, just September? In fact, the Fed has now cut rates by 75 basis points, the Fed funds rate. The 10-year Treasury is up 75 basis points the other direction. So it's a 150 basis point swing between the Fed funds and the 10-year Treasury. This is the opposite of what the Fed had hoped. The purpose of the rate cuts was to bring down longer-term rates too. They wanted relief to the housing market. They wanted to make buying homes cheaper, so they wanted mortgage rates to come down. The markets had believed that cutting rates would be good for the long end. After all, that's what happened with all the other rate cuts when the Fed kept cutting rates. In fact, when it went to zero during COVID, right, rates in the long end went to below 1%. Of course, the Fed was doing quantitative easing at the time. Now they're still doing quantitative tightening. In fact, I think the balance sheet just slipped below $7 trillion for the first time since they started doing quantitative tightening. But as I've been saying, without the Fed doing quantitative easing, long rates are going to keep rising. We're not even close to the end of this as the yield curve normalizes and actually ends up being steeper than normal due to the inflation trajectory.
So there you have it. In a more technical way, many economists believe that the only way to combat entrenched inflation is to raise the Fed funds rate above the 10-year Treasury yield, which is something we were doing for years to fight the inflation of 2020. Now this balance is switching. The 10-year is at 4.41% and going up, while the Fed's fund rate is 4.5% and going down. With the president and other politicians likely to push for lower Fed rates and higher spending, inflation is obviously expected to rise, throwing this delicate balance wildly out of sync. This is what was happening in the 70s and 80s when stagflation was at its worst, and it wasn't until Paul Volcker took the Fed funds rate to 20%, pushing it well past the 15% 10-year yield, that we finally broke a decades-long battle with inflation. Of course, this had severe economic consequences in the form of 2 recessions that most of today's politicians would rather avoid, but that is the problem we're in today, and the Trump trade is a reflection of that reality. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know in the comments where you think this is all going: stagflation or a new era of economic prosperity.